India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We're getting to the thick of things. Yesterday was painful. Today, Gift Nifty is indicating perhaps could be a little bit of a respite. Let's see. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Hi, morning, folks. I call it the day after, the morning after, right? Because after the manic Monday that we got, I think some semblance of just peace and sanity and even range-bound trade, 50-point range. I think traders will be relieved even with that today.
Well, that's right. And wishing all our viewers who are joining in a very, very happy Makar Sankranti. And I think it's Pongal as well today. So happy Pongal, happy Makar Sankranti. And hopefully, I think that's that saying, Til Gul Gyani God Bola.
Yeah.
I think the market participants will say, God Bola Ani Karapan. That's the hope, I guess so.
Well, absolutely. And, best wishes to all our viewers on this auspicious day and those who are celebrating. I mean, really the best from the CNBC-TV18 team. Just hoping that on a day like today, the market also gives us a bit of a break, right? I mean, I think that's the best that one can hope for after the relentless fall that we've seen over the last sort of many sessions now. Actually, in the last 4 days, you got about a 4% fall in the Nifty Bank. That's been the extent of the quick, swift downdrift. So let's start from the beginning, right? I mean, and the problem, of course, was US and the big macro markets, yields, rates, etc. We've not seen anything huge or humongous like what we sort of same time yesterday we were talking about big things. It's more settled. So equities, US equities mixed. S&P was up a little bit. NASDAQ ended about 0.4% lower. The 10-year it was up, but only 3 basis points. We are now up to almost 4.8%. And the dollar index is still there, about 109.42. So, a little bit of a cool-off is essentially what we have seen here. Oil prices, we already saw this price in Asia in the morning, so 80.87. This is not good news. We were at about 80. This is not sort of bad news because we were at 81 when we started this morning yesterday. So it's just that, the change from last Friday shows you up about 1.5%. So in that sense, the dollar, equities, the rates, everything is not sort of cooling off or correcting in the favorable direction, but they're all right. Things that you can live with, especially after what we've already seen yesterday. Later today, you've got the two things. The US CPI numbers will be top of mind. Of course, jobs numbers last Friday, the non-farm payrolls data was the big blowout data point. And can this pull in the other direction? We'll see, but don't keep hopes high. Fed speakers, there are 2 Fed speakers on schedule. Remember, the market has already kind of cut back rate cut expectations in 2025 to maybe 1 or 2. If you are to look at consensus expectations. Some, of course, are saying, well, no cuts this year, maybe a hike. So it's kind of moved in that direction. So in that sense, the speakers and what they say should be interesting and important as well. Now, just to look at the levels and where we left off things yesterday. So we ended below the November lows on the Nifty of 23,263. This is the level that we put out yesterday, but it just sort of went hot knife through butter kind of situation. Markets are oversold in the very near term. If you look at simple things like the relative strength index and other indicators, we are oversold. Look at the swing. We are oversold. On the downside, the next levels are to watch out for are 22,935. So, which is the 22,935 and 22,320. These are levels which are going to be important. Resistance comes in at 23,383 and then at 23,490. I think there is, these are the levels, the resistance levels, which one needs to keep an eye out on. Bank Nifty, resistance comes in, again, simply put, at the 20-hourly moving, 20-hourly average, which is 48,799. And then the 40-hourly exponential, which is 49,293. I'm not putting downside levels for the Nifty Bank because it's looking really, really weak. And I mean, if you start to project levels down, I mean, you're looking at 46,000, some putting levels to about 45, which is about 6% away from where we left off yesterday. So not doing that for now. We'll see how things progress. We've already kind of corrected quite a bit. And in the next, 4 days, 5 days, we have the big event of the Trump swearing in. And lots of things are moving, lots of moving parts really here. But the backdrop is the market, which has kind of cooled off quite a bit over the last few trading sessions, especially 110 points higher. Let's see if this lasts. Surabhi.
Okay, absolutely. The markets will just hope for some sanity to prevail. At least, like I said, some range-bound trade also would be perhaps welcome after the mega fall yesterday. So Asian markets are actually mixed. The bias is positive in most of them. Barring Japan, you can see some green on Taiwan. Hong Kong is actually one of the better performing markets today. Japan is now down 2% because it's playing catch up. Japan was shut yesterday while the world was taking in the onslaught of the reality of the US jobs report. So now the catch up in Japan is taking that market, the Nikkei, down almost 2%. Otherwise, things are okay. The US dollar and the US 10-year yield both are still near the recent records that we're talking about, 14-month high for the US 10-year yield. So still around that level, so it's still a bit jittery. For us here, yesterday's slam dunk has now wiped out all of the gains that this market made after the general elections. And we've come back to the level of around 7th of June. So we had that major volatile day, the day the results were announced, and then the recovery. After that, 7th of June was the intraday low, was where we are pretty much at. So let's see if there's going to be a reversal from here or not. The flows picture reiterates one thing, that aside of the FPIs and the domestic institutions, there's still obviously a very large market out there that's not captured in the institutional data. Because despite this kind of domestic institutional buying, which is more than offsetting the FPI selling, look at what the market did yesterday. That's telling you what HNI is doing, ultra HNI is doing, what family offices are doing, and even what direct retail is doing. And that's where the panic is. And that explained the absolute crackdown in the mid-cap market yesterday and over the course of 2025, really, with the mid-cap index sliding well over 10%. So this is where the pain is. It's not the institutional segment. It's a non-institutional participation that's really hurt in this market decline. Anyway, let's now talk about some good news. And I have 2 points here to sort of, bring out. One is inflation. The inflation number that we got yesterday is showing a bit of a cool off, 5.22, which is also a little lower than what our poll was. And there is some respite in both food inflation and in core inflation as well. Food inflation has moved, at least it's moved away from that 9%, ugly headline kind of a number to about 8.39. But we have to keep in mind that these are numbers looking at the rear view, right? We know what's happening with oil prices right now, here and now. So is this really going to cheer the market? No one really knows for sure because we have tariffs to deal with, we have oil prices to deal with, we have geopolitics to deal with. So let's see if this is a sustained trend or not. But for what it's worth, it was at least a decent number. No shocker on CPI inflation. No shocker from HCL Tech either. Pretty decent, more or less in line with numbers. Constant currency, growth is about 3.8%, little shy, just a shade below what the estimates have been, but not too bad. The margin has improved 90 basis points, but that is on expected line. So it's not a very huge positive surprise. Rima was telling us, and this is exactly in line with the poll that she did. What is the management saying? The management is cautiously optimistic. I always look at commentary a little more, especially with IT companies these days. They're saying there is improvement in demand. Discretionary spends are picking up, but they're saying that smaller deals are getting converted quickly while larger deals are still taking time. So yes, it's positive commentary. With also a slight tweak of the guidance. The lower band of the guidance has been increased. So now the new guidance is 4.5% to 5% versus 3.5% to 5%. So they've narrowed the guidance and bumped up the lower end of it, which is also good news. So hopefully, once again, it's going to be tech to the rescue, offering some leadership, some respite, and maybe some green to the screen.
Well, just going by all the data points that we have, I think select large cap names will start outperforming from here on, and quality mid cap names as well will see a fair bit of interest. Let me go to the ball and, in fact, tell you more about that. I think that there could be the smaller cap names that have gone up, not backed by fundamentals, that will still see some pressure. But a large part of the market, which is quality in nature and which will deliver, will do well from here on. However, the global backdrop is a bit of an issue because you have Brent crude prices, the US yields and the dollar index, they're at elevated levels. But just talking about the institutional numbers yesterday, I don't think it is that bad. And I think yesterday and day before as well, the weaker hands got taken out. And I have 2 big points out here. One is, as you all mentioned, the institutions, they were net buyers in yesterday's trading session. Looking at the FI data, we've been looking at the index futures. Well, yesterday, surprise, surprise, they added more longs than shorts. And in fact, it was quite a sizable number as well. So 2 longs were added for every 1 short position in stock futures. And both these two give me some kind of confidence that maybe today could be a relatively better day. The FI short positions, they have been building onto their shorts and they continue to do that. Even in yesterday's trading session, they added close to around 18,000 short contracts in trade. Clients, they are going the opposite direction. They have been net long and they continue to add those long positions. And just looking at the net long position on the client side and the FI net short positions, there's a similarity to what we saw in June. And that's the level from where the Nifty did bounce up. So the clients in June, well, they were close to 3.3 lakh contracts on the long side. You had them right now, they're at around 3.2 lakh contracts. And the FIs, they were net short by around 3.5 lakh contracts. We're not yet there, but we're still at around 3 lakh contracts odd. So normally when you have both these two extremes playing out, then you get a bit of a bounce just in the near term. The trend is weak, but I think there's a strong case that we see a bit of a bounce, particularly on the headline Nifty index. The FIs, well, in the stock futures, as I said, 2 long contracts added for every 1 short contract. And that data point as well is quite a positive from a stock-specific perspective. The PCR, that's moved to the lower end of the range. So that's another indicator that in the near term, we are relatively oversold. And if you look at the options data as well, 2 strikes come up for you on the screen. Call writing has become too easy, right? 23,200 call. Well, that's a fair bit of interest. But what's giving the bulls some kind of heart is that this 22,800 to around the 23,000 odd mark should hold out. And that's where the crucial support comes in at. You know, this is a very, very important mark. The bulls will have to put in a fight. This technical indicator is extremely important. Resistance, going by the options data, comes in at around 23,350 or thereabouts. The sow point for the markets has been the Nifty Bank. And on a day-to-day basis, it's making lower highs, as you can see, the last few days. And if you look at the lows, well, it's making lower lows as well, you know, on a day-to-day basis. So the Nifty Bank needs to give up this relative underperformance that we've seen. And let's just pull up the lower highs, because for today's trading session, the important mark that you're looking at is around 48,600. The bulls will want the Nifty Bank to get about this mark to break this trend that we've seen.
Okay, all right. Hopefully the bulls will get some sort of a fighting chance today. Let's kick things off with the equity call of the morning. Lawrence Belanco of CLSA says the lack of follow-through buying in December has left the Nifty oscillating around its 200 DMA and threatening support provided by the November-December lows at 23,263 to about 23,460. A break below these support levels will be a bearish signal. Such a move would also support a downside target of 22,000. From a sector perspective, Lawrence adds that IT is the NSE banks. It's the NSE banks price action that is a concern for the broader market, as Friday's close has resulted in the sector's breakdown from its June 2024 to Jan 2025 trading range, with a close below 49,700 to 50,000. This breakdown supports a downside target of 45,000 for the Nifty Bank, which is around a further 7% downside.
Okay, well, that's Lawrence Belanco. It's a closely watched technical analyst, and we'll be speaking with him in the days to come as well. But that's the view, the latest view coming in from Lawrence. Jeffrey Dennis is independent emerging markets commentator. He's with us now to take some questions. Jeffrey, great to have you with us here. It's not so much, markets have been roiled a little bit, especially here in India and EMs, etc. US may be starting its leg lower, I don't know, because that's been the strongest market by far, by some distance. So what's the dominant driver? Is it Trump and what he could do with tariffs, or it's just the underlying strength of the U.S. economy, which has brought back fears that perhaps 25 will see no rate cuts?
I think it's both, frankly. I think the market is very uncertain about quite what Trump will do in terms of the scale and the breadth of tariff increases. At the same time, we need to know what tax cuts he's thinking of doing. Obviously, the most likely thing is to prevent the sunset of the income tax cuts that he put in place when he was previously president. But the bottom line here is that if you look at what the market is concerned about with these potential Trump policies, they lead, in theory, everything else held constant, to higher inflation and a wider budget deficit. And if you combine that now with also this blowout employment report for December that we got on Friday, This is just contributing to higher bond yields and a stronger dollar. And as you say, significant risk now that the Fed may not cut rates at all in 2025. Now, I put my outlook out about 5 days ago on the 8th of January for the year. And my call is that bond yields go considerably higher from where they are now into the 5 to 5.5% range. I see the dollar continuing to strengthen from here for a while, and remains to be seen what they'll do on the interest rate front. So I'm not surprised we're seeing this decline in the early part of the year, especially for emerging markets. But obviously, as ever, it all depends on what Trump does, and it depends on what the economic data in the US will look like as well.
Jeffrey, just one point on Trump, and this was an interesting, I don't remember where I read it, but it stayed with me. It's essentially said that what we're seeing now is peak Trump. So he's not president yet, so he can say whatever he wants, and, he can make all kinds of claims, I'm going to do this, I'm going to do this. But once he's in that seat, he's then president, and then he's bound by actually, first of all, doing things which will affect things, and there'll be first order, second order implications. There'll be a team around him. So in that sense, I mean, this is the peak. And in that sense, it'll get a little better once he assumes office. Does that make sense broadly?
Yeah, I hope you're right. It didn't happen last time when Trump came into office. Of course, he carried through a lot of the things that he was threatening. But one of the famous, as you will all know, market expressions is you sell the rumor and you buy the news. And when Trump comes in, it could well be that this signals a change of direction. But my worry here is that almost whatever he does, or indeed doesn't do, we have a major budget deficit problem developing in the United States. And I do think that while the economy stays strong and the budget deficit continues to widen, it's around 6% of GDP now, I don't see any alternative but for bonds to remain somewhat under pressure over the next several months. And I think that's going to be the big driver of markets generally. Sure, we don't exactly know what Trump will do. It's a shot in the dark. It's a gamble. But frankly, the macro trends generally are towards, as I say, wider budget deficit, inflation leveling out. I don't think this is good for bonds. I think it's strong for the dollar. And I think it's a tough environment for EM, as I said, I think on this program the last time I was on.
Mr. Dennis, hi, good morning. Absolutely. So therefore, my next question, given that it's getting so complicated, right? Now with the inflationary concerns in the US, these rising bond yields, we're seeing the rotation out of tech stocks, for instance. They're not rising in a straight line anymore, and the specter of maybe fewer rate cuts. So where does money move? Where do you see money moving in the next couple of months? Because, I mean, I would ask you whether it's going to come back to EMs because there are problems in America. But then EMs, we don't know who gets slammed with what kind of tariffs. So that's another complicating factor. Where do you see the money moving over, say, the next 3 months?
It's very hard to be sure about that. I mean, one of the interesting things is that we've had a very contrarian move in some of the big emerging markets so far in 2025 compared to 2024. So Korea is up a lot, having fallen sharply last year. Taiwan and India, as you know, and also China are down a fair amount. Brazil has started to rally. And so you've seen a bit of a contrarian move, which in some sense is sort of consistent, although different from what we've seen in the US with a rotation from tech stocks to elsewhere in the market. Through all of this sort of complicated, challenging start to 2025, what you've got to remember is that EM is still underperforming DM. EM's down about nearly 3% year to date. US is down a little bit, DM's down a little bit. So we need a complete change of direction, in my opinion, in terms of bond yields and the dollar. And in case of India, I think oil prices for, the markets, the people to start putting money to work in EM, which could, of course, happen later in the year. But right now, I think finding pockets of strength is difficult. I would take a look at Brazil. I would take a look at Korea. I would take a look at other markets in Latin America, which did so poorly last year, although probably not Mexico. I would look in elsewhere in EM, in South Africa, in Turkey, and I frankly I think despite the volatility so far this year, I still see the US outperforming Europe, where the macro situation is so poor now and seems to be getting worse.
Okay. All right. Well, let's see. We do live in fairly complex times. Thank you for joining in for a quick chat today, and we hope for more in the coming few weeks as well. Well, let's quickly move on and talk about what's lined up on the show today, and it's a packed show as always. Coming up at 8:35, we will be in a conversation with Anil Yadav of IRB Infrastructure to talk about the December toll collection trends. At 9 o'clock, we look at the currency full throttle after the huge weakness yesterday. What lies ahead? We get chatting with Jayesh Mehta of DSP Finance. At 9:20, Samiran Chakrabarti and Surendra Goyal of Citi are our market masters. We get the Citi view on India, the economy and the market in just a bit from now. At 9:40, it is all eyes on HCL Tech. We'll look at the commentary and see how HCL Tech is reading the picture for the rest of the year. At 9:50 a.m., Pranav Gundapalli of Bernstein joins in with the key expectations from the banking sector this earnings season. And towards the end of the show, in our special segment, It's the Economy, Lata will be in conversation with the Forex rates expert, Kamaksha Trivedi of Goldman Sachs, to talk about the rise and the rise of the US dollar, and of course, what lies ahead in the currency universe.
Well, time to slip into a short break. We've got a lot of stock-specific action that we're tracking for you in our special Top 10 segment. For the time being, I'll run you through the list. We're looking at JSW Energy, Anand Rathi, Himadri Specialty, PEL, Adani Green, Piramal Enterprises. All of them will be reacting to positive news flow. On the flip side, HCL Tech, United Spirits, Delta Corp, Angel One will be reacting to the negative news flow overnight. Slip into that break, come back. We'll get into further detail on all of these names.
Welcome back. Well, the cues are a little more even this morning. The implied open is suggesting that we'll pull back by, who knows, at least 100 points or so. Let's look at individual stocks now, and there are plenty to track this morning as well. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off first with HCL Tech. Rima joins in. Rima, so on point?
Thanks so much for that. So HCL Tech's numbers were largely in line with street expectations. Revenues were slightly lower. Constant currency revenue growth came in at 3.8%, lower than consensus expectations of about 4.1%. But margin expansion is intact. The company's margins expanded to 19.5% versus 18.6%, and that drove an 8.5% increase in the company's profitability. So margin and profit performance was in line with street expectations. The company has also raised the lower end of its full-year revenue guidance. The earlier guidance was 3.5% to 5%. Now they're talking about 4.5% to 5%. And one of the reasons for the upgrade at the lower end is on account of the HPE asset acquisition that the company concluded in just December. Margin guidance remains unchanged at 18% to 19%. Deal wins are steady, a little over $2 billion. The management commentary is also fairly upbeat. They're talking about their deal pipeline being at an all-time high. Large deals were signed in AI and generative AI led. The average tenure of the signed deals is getting shorter. So overall, the commentary is fairly positive, and they also indicated the clients are looking to increase their IT investment in calendar year 2025.
Thanks a lot for that, Rima. In fact, we'll have the management who will be joining us here on CNBC-TV18 at 9:40 a.m. But let's move on to the next stock that we're looking at. Sudarshan joins us to tell us about JSW Energy. Morning, Sud.
Morning, Nigel. So I'm going with green for JSW Energy. His company has acquired KSK Mahanadi Power under corporate insolvency resolution process for the total bidding amount of nearly 16,000 crore, that is rupees 15,985 crore. And company had outbid NTPC and Adani Power. Adani Power's bid was around 15,008 crore. And closure of this deal will be subject to regulatory approvals, that is NCLT and CCI. So currently KSK Mahanadi Power owns total thermal power plant capacity of nearly 3,600 megawatt, of which 1,800 megawatt is operational and another 1,800 megawatt is under construction. So what will this deal do to JSW Energy? post this deal, JSW Energy's lock-in thermal generation capacity increases to 7.5 gigawatt, and company believes this deal will help achieve the target of total power generation capacity of 20 gigawatt much before the company's target of 2030, and that's the reason I'm going with green for JSW Energy.
All right, so thank you very much for that. Coming back to you for more in a bit from now. Well, United Spirits is in focus, and so is Delta Corp. Mangalam is here with to tell us why. Mangalam, morning.
Good morning. So for United Spirits, another day. In fact, after a surprise exit of Neville Narona from DMart, United Spirits also will have an exit. Hina Nagarajan will step down from March 31st of this year itself. And the reason why she will is because she has to take over other responsibilities in the Diageo group itself. So maybe a promotion up as against, just a resignation. The company will have Praveen Someshwar, who will take over as MD CEO starting FY26. Praveen Someshwar has been the MD CEO of HT Media for the last 5 years. Prior to that, he was with PepsiCo for the last 24 years. This is typically a risk for MNCs where key leaders are moved out into different geographies or at the global leadership itself. So smooth transition is something that the street will eye. Until then, there will be some bit of uncertainty, see red out there. And also see a lot of red on Delta Corp because the company reported what was a weak performance in a seasonally strong quarter. And that tells you that, structurally, the demand for casinos may have been dented a little bit because of the GST regime at 28% for all the bets. Revenue is down 7.5%, and that's played out in the operating performance as well. EBITDA down 42%, and the net profit has shown a minor growth only because there was a tax credit of 6 crores versus a tax expense of 15 crores. There was, decline in the casino business revenue, down 3.5% in terms of revenue. Operational performance as well, the EBIT down by 20%. For online business, while the revenues increased by 16%, the EBIT loss increased from 1.7 crores to about 18 odd crores. Yes, the company has admitted that there is a relief in terms of a stay order to the claimed GST, but then again, they hadn't made any provisions for that. The bigger trigger for Delta would be any change in the actual GST, implementation of 28% across all face values of bets.
Okay, absolutely. So we're going to watch out for this, see the impact on Delta and, of course, United Spirits as well. With that, let's quickly move on. We have Vamakshi joining in. She's looking out at some of the results and updates we've got in from Angel One as well as Anand Rathi. Vamakshi, good morning.
Well, not a great set of numbers coming in from Angel One. Revenue saw a downtick of almost 17% sequentially. EBITDA margin too saw a dip of nearly 507 basis points to 39.3%, and the net profit was down by nearly 34% sequentially. Largely, the decline in revenue was being led by the net broking, which was down nearly 10% sequentially, and this was mainly on account of impact from the F&O regulations on F&O brokerage and weak market sentiment on the cash brokerage. The net interest income too saw a downtick of nearly 6%, and this is largely better than what the analysts were expecting. But it is the higher OPEX that has led to a decline in margin as well as the company's profitability. The cost-to-income ratio has risen to 60.71% as compared to 55.6% in Q2 of FY25. In addition to that, they've appointed Ambarish Kenge as the group CEO of the company with effect from March 6, 2025. So overall, a weak set coming in from Angel One. Anand Rathi is the next counter I'm watching out for, going with the green for this counter, and that is because they've gone ahead and raised their revenue guidance to 980 crores from 910 crores and raised their net profit guidance to 295 crores as compared to 280 crores. AUM for the company, the growth was rather subdued at 1.76% sequentially. The AUM guidance, however, remains unchanged at 80,000 crores, 95% of which has been already achieved in the first 9 months of FY25. The net inflows, however, saw a good uptick of almost 47% sequentially. Revenue from operations were down nearly 2%, but the operational performance of the company was better because the PBT margin improved by 180 basis points to 43.9%. The net profits saw an uptick of nearly 2% sequentially. In addition to that, the board has approved bonus shares in the ratio of 1:1, so expect some uptick on that front as well. So going with the green for Anand Rathi.
Okay, all right. Thanks a lot for that, Vamakshi. But let's wind this down then with Upasana, who's here to tell us about Himadri Specialty Chemicals and BEL. Upasana, take it away.
First up, let me start with Himadri Specialty Chemicals. Well, overall, the company has reported a good set of numbers. The revenue saw an uptick of 8% on a one-web basis, and EBITDA stood at 221 crore with a growth of nearly about 27%. Now, company's key segment, that is carbon material and chemicals, has expanded sharply. That is nearly about 370 basis points at 16.3% is what the expansion has come in at, leading to an overall margin expansion of nearly 290 basis points. So overall margin started at 19.4% versus 16.5%. Company's PAT stood at 142 crore with an uptick of 30%. This is mainly because of company has taken various cost optimization measures. Now, mind you that the board has also approved a new capex of 120 crores for manufacturing of specialty products at its Singer facility. Hence, this stock will remain in focus on back of the results. And next up is BEL on back of its order wins. Now, company has secured additional new orders worth 561 crores since the last disclosure of 23rd December 2024. While these orders with these orders, BEL has now accumulated orders totaling up to 10,362 crores for the current financial year. Hence, even this stock is what we'll be keeping on our radar.
All right, Upasana, thank you very much for that. Adani Energy and Piramal Enterprises are the next two names we want to focus on. Vamakshi is standing by with details. Vamakshi, morning.
Well, good morning, Prashant. The Adani Energy Solutions will be in focus, going with the green for this counter, and that is because Q3 transmission network length stood at 26,485 circuit kilometers. This is an uptick of nearly 30% year-on-year is what they've witnessed. Q3 power transmission transformation capacity saw an uptick of almost 54%. The Q3 average system availability was more or less flat at 99.69%, and the transmission availability stood at 99.21%, slightly declining on a year-on-year basis, but going with the green for this counter. Piramal Enterprises is the next one that I'm watching out for. Keep in mind that the company earlier on June 26, 2018 had informed about the divestment of Piramal Imaging SA, which is a step-down subsidiary to Alliance Medical. The company has now been informed by Life Healthcare, which was a part of the group that acquired Piramal Imaging, that they have entered into a binding agreement for sale of Life Molecular, which is a member of the imaging group. Resultantly, on completion of this proposed transaction, the company will become eligible to receive nearly $140 million in FY26. The company may also receive further amounts in subsequent years from any eligible profits and future earnouts relating to the imaging group. And this, amount has been capped at $200 million over the next couple of years. So going with the green on this counter on the back of this development.
Okay, all right, Vamakshi got it. So we're going to keep Piramal Enterprises on our radar as well. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow are JSW Energy, Anand Rathi, Himadri Specialty Chemical, BEL, Adani Energy, and Piramal Enterprises. Stocks with negative news flow are, well, HCL Tech, maybe negative to neutral, you can say, United Spirits, Delta Corp, and Angel One. Okay, let's talk about something positive that came in after market hours yesterday. India's December consumer inflation came in slightly lower than expectations, also lower than the previous reported print. And there was some cool off in both food inflation as well as core inflation. We have Lata joining in with the details. Lata, I don't want to be a pessimist, but the thing is, this is data, rear view looking data, given what we're seeing on crude oil prices now. But anyway, what does the fine print tell us?
No, I think it's a very good set of numbers. At 5.22, I had got an average of 5.3, but there were quite a few on the street expecting 5.4, poll numbers which came after I completed my poll. So I was worried that it would overshoot, and actually it's undershot considerably. As well, it's now 3 months in a row falling. It was 6.2 in October, 5.48 November, 5.22 December. And if you looked at the nowcast numbers for January, it is expected to be much more sharply down. So we are going to be 4 point some decimal point average for Jan, Feb, March. So I would consider it a good number. The big contribution has come from core. That was expected to remain at 3.7 or go to 3.8, non-food, non-fuel. That's actually come at 3.6, largely because of gold and silver, though not only because of that, but that's again an important contribution. And then let me come to food. Now, food is good in the sense it's 8.4 compared to 9.04 in November. But, our poll still threw up 8.3. So even the economists were kind of disappointed by the food prices not falling enough. Now, vegetables actually did the heavy lifting. They are still 26% higher year on year. But, look at the way it has fallen. All the way from September, this is one of the lower numbers we have got. And if you only took tomatoes, onions, potatoes, the top set, it's actually fallen considerably and is expected to really crash in January. where is the pain coming? Edible oils. You know, edible oils, we raised tariffs for the benefit of farmers, and global edible oil prices have been going up, and that's getting transferred. So look at that, a year-on-year rise of 14.6. Fruit and eggs have also hinged up. I'm giving you all the numbers where the inflation is above 6.5%. And that's cereals. See, you wouldn't expect that there will be a month-on-month rise in cereals as we enter the post-Kharif season harvest coming in. But, you know, wheat prices have gone up. So I'm a little worried about this part of the food inflation. Nevertheless, veggies are going to be the big relief going forward in Jan. And therefore, the expectation that inflation will finally come down to 4.5% by the time come to, March and then to 4 is very much alive. Just one more detail I must point out. You know, month on month inflation falls in November, December, Jan, Feb because vegetable prices fall. It usually falls by 0.4%. The expectation, if it was 5.3, was it will fall month on month by 0.5. And you know how much it's fallen? Actually, 0.6%. Now imagine if you get a 0.6% fall month on month in the remaining 3 months, that would be a good number. So my sense is that the Reserve Bank governor actually gets some space to cut rates as early as February. The street is divided. There are some who believe that he will wait because of even the interest rate differential. But clearly this inflation number, give space. The former Governor Das was saying that it must align to 4%. But the new governor may say that, so long as it is showing a direction, there is space. So clearly today there's something to cheer for the bond markets.
Okay, all right. So that's something to cheer. And also in the last, 12 hours or so, we have the dollar index that yesterday when we were closing trade, it had breached that 110 odd mark. That's cooled off. I think the last count is around 109.6. That as well will be a little bit encouraging. Looking at some positives, so a couple of them, as Lata said, inflation data looks pretty okay. You have the dollar index that's cooling off a wee bit as well. Let's find out what's going on in the commodity space. We have Manisha who joins us to help us out with that. Morning, Manisha.
Morning, Nigel. Thank you for that. It's not just the dollar index that's cooling off. The crude oil prices also are off their highs and at least have paused on that rally where we saw 6% of gains in the crude prices in the previous week. So that could be some good news for the Indian markets as well. While we are trading very close to the 4-month highs and most of the fundamentals are still supportive and positive, there is some profit taking. So after hitting almost 82 on the higher side, we are trading below 81 right now for the Brent crude oil prices. Well, the street will also watch out for the U.S. inflation, weekly jobless claims and retail sales. All of that data comes in this week as well. The markets also have seen strong U.S. jobs report coming, and it is really going to be important to see on what China does going forward, because that would tell you in sense of stimulus on how many of these commodities would perform. So even as there is some profit taking across, metals is a sector to watch out for. After that sharp fall, we have seen iron ore prices trade at a 1-week highs. Copper is right now trading at a 2-month highs. The China unwrought copper and product imports has surged by 18% for the month of December. That is a 13-month high. And not just iron ore and copper, aluminum also has continued to surge. We're looking at a 4-week highs in case of aluminum as well. So ferrous, non-ferrous metals have started Asia on a positive note today.
Okay, all right. Manisha, thank you very much for that. That's Commodities in Focus. We're going to take a quick commercial break here. We're going to come back in just a bit. Hemang Jani will be with us with some fundamental stock conversation that's lined up on the other side.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, let's focus on the first corporate on the show, IRB Infra. That's the first management. The company reported 19% year-on-year growth in the toll collections for the month of December. The total toll collection for the month amounted to around 580 crore rupees. To discuss this, what are the trends witnessed currently, we're joined by Mr. Anil Yadav, the Director, Investor and Relations at IRB Infra, who joins us on the show. Hi, Anil. Good morning, and thanks a lot for joining in. First time we're speaking this year, so wishing you and your team all the best for 2025. Let's talk about December, though. Good toll collections, 19% increase. A lot of people traveling, so that could have helped you all. What caused this, according to your analysis, and how do you see the trend going ahead? Expect to keep up the momentum?
Thank you. Good morning, and thanks for having me here. In terms of the toll collection, we have seen a robust and healthy growth in the month of December on backdrop of the festive season and year-end traveling. And with respect to, I think the momentum has continued in this month as well. And we are seeing the healthy growth across the portfolio.
So can you, Mr. Yadav, so can you show some more color, throw some more color on this? I think your collections were up about 24% in December. So what are the trends so far in January, and what are you seeing? I mean, which are the assets across which you're seeing the maximum traction?
I think in terms of the toll collection, we have seen a healthy growth in terms of, if I will talk about only the traffic, 6-7% kind of traffic growth is there, and plus tariff revision, whatever we have got in the last year. On backdrop of that, we are seeing a very healthy growth in the month of Jan as well. Though on the north side, because of the heavy winter, there is some softness in the traffic, but as compared to the last year, still the growth is very healthy.
6-7% is the traffic growth, and the remainder is the price increases. Is that correct?
Yes.
Okay. In terms of tariff, revisions, are any more immediately lined up, say in the next 1 quarter or so, for any of the other assets that you're operating?
Yeah, tariff gets revised from 1st of April every year. It's the polar-driven tariff revision. It's a 3% fixed plus 40% of the WPI. So from 1st of April, we will get that tariff revision across our portfolio.
Okay, so across the portfolio, it's the same date, 1st of April. Got that. Let's talk about then, the increase you're seeing across the order book. Give us a sense what's happening with some of the EPC projects as well, and what you've penciled in for FY25.
I think if you look at IRB today, well, 85-90% value comes from the asset. EPC business is just complementing our asset business. And in terms of the EPC, we have approximately 30,000 plus kind of order book. Out of that, around 28,000 crores order book is the O&M order book, and roughly 4,500 crores is the EPC order book. Total order book is 32,000 plus crores. And we have next 6 quarters execution available. And gradually we are moving from the EPC. Our EPC is tilting towards more O&M. From 10-12% kind of execution of the O&M in earlier years, now it's gradually shifting to around 25% kind of execution of the O&M. And O&M, you can have a long-dated order book. We have roughly 20 years visibility on the O&M order book. Now, in terms of the EPC, we have visibility for 5 to 6 quarters. And as you are aware that in this year, because of the election, the award activity was pretty low. And we believe that, as we have witnessed in the past as well, this 2 months will be heavy in terms of award activity.
All right, Anil, final question before we let you go. You've given us an insight in terms of your business. But what about CapEx spend? The cry from everyone is that the CapEx spend hasn't been enough. And that's why all eyes are on budget 2025. Hopefully, there's going to be that much needed booster shot. Your analysis, what's the, what have you been seen on the ground? Is the CapEx spend picking up? And what's your expectation from budget 2025?
So I think in terms of CapEx, as there is talk from all sectors, the CapEx was very slow. And in terms of our sector also, if you look at award in last 10 months, is hardly 20-25% of the overall target, what government has targeted to be awarded. But typically in our sector, last quarter typically sees roughly 50-60% kind of award coming in the last quarter of the financial year. And we are hopeful that the award activity will pick and there will be award in the Jan, Feb and the March. And in terms of the budget, I think we don't have much expectation from the budget. And we are basically, we spend the money. So we have partners like GIC and Ferrovial, and we execute the project in the ratio of 51-49, where the 51% equity is brought in by IRB and balanced by the two partners. So that's why we are only bid for the BOT and TOT, where the capex mainly comes from the private sector like us. Then the government is spending on the capex.
Okay. All right, Mr. Yadav, we'll leave it on that note. Thank you very much for joining us this morning. That's IRB saying that traffic, has improved by about 6-7%. The rest is the higher toll revision, and all put together, it's been a good December, and so far looks like a decent January as well. Let's move on and say good morning to Hemang Jani, who's joining in for some fundamental ideas. Hemang, hi. Been a really tough market, right? Last couple of days. Let me start actually with some of the bigger stocks that are in news today. HCL Tech, the numbers look okay. But the issue is with this guidance revision, only the lower end of the band has been increased, not the upper end. I don't know if that's going to weigh on the market sentiment. Commentary seems cautiously optimistic. How would you look at it?
Morning, Surabhi. Thanks for having me. So yes, I think the numbers have by and large been in line, and more so the margin has been a bit of a positive surprise, and the outlook continues to look good, while we would have expected the guidance to be much better. It's been a bit lower than the general expectations. The interesting aspect about HCL Tech is that for past many quarters, they have done much better than its peers, namely Infosys and TCS. And now there is a bit of a parity between the valuations, between HCL Tech, Infosys, and to some extent TCS. And we do think that going forward, given the diversified portfolio of HCL Tech, it will deliver much better growth. So definitely, it should be a core allocation stock. And we do think that there is a case for 18 to 20% kind of an upside. It might pause a bit because the entire sector has done well over the past few days. But from a medium term to 12 months kind of a perspective, this would do much better than its peers.
Okay, all right. Hi, Hemang. Good morning and good to see you in. Hemang, I want to talk about market participants. And in that backdrop, what do you make of numbers? If you looked at Angel One or Anand Rathi, what do you make of them? And also BSE. Jefferies has come out with an interesting note. Everyone's talking about volumes falling, but they have highlighted that the premiums actually, which is the one that is related to revenue, that's fallen by less than expected. How do you play this theme?
So, Nigel, as far as Angel One is concerned, I think, a large part of their revenue is coming from the options or the derivative side. And which is why we've seen, a significant cut on a quarter-on-quarter basis. Now, they are facing two challenges. One is that the overall volumes have been on the lower side. Two, when the ticket size has been increased, the company will have to decide on its pricing strategy going forward. So I believe that Angel One as a theme has done very well over the last 2-3 years. But from here on, it would make sense to go with either PSC, which is relatively better placed, and despite the new F&O norms, if you look at the absolute growth, even in December, when the volumes were down, they did much better because their income is linked to the premium, and the premiums have been relatively better off. So I do think that, BSC surely, because on the one side, it's, gaining the market share on the weekly side, and its premium income is remaining strong, and their margins are improving because their cost is related to the exchange cost and not relating to the volume per se. So BSC surely is a better bet. Anand Rathi consistently has been delivering better results. I think if you look at last, 4 to 5 quarters versus the guidance that they put out, they are doing much better. And their dependence on the brokerage income is much less. So I think that within the capital market theme, one will have to really figure out which are the pockets where you will continue to see a decent growth despite these new norms being in place.
Okay, Hemang, stay with us. We're going to come back and discuss more stuff, but we have to take a break here because we want to get into the technical perspective as well. Mitesh Thakkar and Sudarshan Sukhani join in for that on the other side. Stay tuned. Okay, welcome back. There is, of course, 6 minutes to go for the pre-open session. Mitesh Thakkar and Sudarshan Sukhani are with us. what they'd want you to do with today's session. GIFT Nifty indicating, pointing towards a 100-point pop. Mitesh, yesterday was a really waterfall kind of a day, ended pretty much at the day's lowest point. If you manage a slightly higher start, 100 points is what GIFT Nifty is indicating. What should be the strategy?
Yeah. So, Prashant, I think the structure will not improve with a 150 point kind of a pullback. Two, we are oversold and extremely so. I think, what can happen is that possibly a choppy range can evolve. The key factor here would be how does the market reacts as it kind of approaches the November low. So 23,350, which was broken yesterday, that zone is very important. So I think a bounce back to about 23,300, 350 would be very normal. That is when I would attempt some kind of short with a 70-odd point stop loss. In case we start getting past 23,350, then we'll assume that, one leg of downtrend is over and we might be in for a short-term bounce back.
Okay, all right. So some factors on board for a temporary pullback, but that pullback could be a shorting opportunity. Well, Mitesh, to back up that view as well in terms of a bounce, inflation is a little bit cooler, so that's good news. The dollar index is a little bit softer and Brent crude price is a little softer as well. So hopefully that bounce has come about. And then, as you said, the trend is still weak. What about individual stocks, Mitesh?
On the stock side, I have more of buy calls today. Of buying on Bajaj Finserv with a stop at 1654 for targets of 1750. And, the FMCG pack was a BTST yesterday as well. HUL today morning can also be bought again with a stop at 2425 for targets of 2500. Kalyan Jewellers, extremely oversold at a very key support level. So buy here with a stop at 560 for targets of 595. And one sell call, KI Industries, on a bounce back to about 3950, 3965 zones. Try and get into some short position with a stop at 40.50 for targets of 37.80.
Okay, all right. Mitesh, thank you for that. Coming back to you for more, because individual stocks have taken a big plunge, so I want to address those as well. We're going to come back in a bit. We'll have Ayush Mehta of DSP Finance joining in. The rupees, of course, we have Jayesh Mehta of DSP Finance joining us. The rupees, of course, fallen sharply. What to expect from here on? That's coming up.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we've heard Mitesh's call on the markets. Let's get in Sudarshan Sukhani as well. Morning, Sudarshan. Thanks a lot for joining in. Well, how do you view market setup for today? Are you expecting a bit of a pullback, or do you expect things to slide from here? So your call first on the Nifty. Please go ahead.
Sure. I see. Good morning. And the 100-point rally that we are seeing in the GIFT Nifty is not relevant. We fell 100 points yesterday afternoon in just half an hour. So this is no big deal. But what is important and much more significant is the behavior of the US markets yesterday. The US markets, the S&P 500 opened significantly lower with a big gap down. But during the day, it recovered all its losses and actually closed in the green. That's the interesting part. So I think it is quite possible that India may follow the US markets, which we usually do. But today is a day when we look for buying. Now, this is only intraday. There is no change of trend. But whatever we get, we should be happy. So I would be a buyer today after the first 15-20 minutes of cooling off, and then see where the market goes. Your stops should be tight about 150 points from where you enter. But it's worth taking a long trade.
Worth taking a long trade after the initial sort of action, whatever has to happen, and maybe then. Sudarshan, in terms of individual stocks, what's on your list?
Well, it's mainly on the long side. Bharti Airtel is a buy with a stop under 1450. Infosys is a buying opportunity with a stop under 1800. I must add that Infosys is also a positional buy. The charts are suggesting a significant up move is coming. Now, given the market conditions, we can't say when that will come, but it should sooner or later. Apart from Infosys, Tata Consumers is a buying opportunity. stop under 940. You see how FMCG stocks are doing well when the broad market goes down. And I have one intraday short, that is Manappuram. That was a disappointment yesterday. Intraday short with a stop above 178. But today we should be looking to see some cheer in the markets.
Okay, all right, some cheer in the markets. So that's something that we'll be hoping for. Thanks a lot, Sudarshan, for joining in fact, giving us that call. Hemang Jani is still with us. Hemang, I wanted to ask about United Spirits. This alcohol theme seems to be finding momentum and seems to be finding favor with investors as well. Unfortunately for United Spirits, there's a change on the top, which could make the street a little bit nervous. What's your view on the stock, United Spirits?
I think operationally, Nigel, the company has done well, particularly on the premium and above category, where the volume growth is high single digits. Also, unlike UBL, where, in Andhra and few regions, there were some pricing related issues, United Spirits is relatively better off. And typically, this second half tends to be much better for the spirit companies. So overall positive view on United Spirits. I don't think the management change per se is going to be that relevant, but the transition part is something that the market will keep an eye for. Overall positive view there.
Overall positive view being maintained. By the way, any thoughts on IndusInd Bank, Hemang? There was that MSCI news flow yesterday, some $200 million worth of stock needs to be bought, but that's passive. I think Bernstein has got IndusInd in its portfolio. High was, I think, 1700, stocks at about 900 around levels now. Q3 won't be good, but it's corrected quite a bit. Any specific thoughts?
So Prashant, most of the negatives are already priced in. After last Q2, the stock is down almost about 22%. As far as their microfinance portfolio is concerned, I think they're trying to get rid of that, and that would surely be a positive. I do think that for those who are looking out for a bit high beta kind of a play, this would be one stock that I would be comfortable buying into because of better valuations, and now the worst seems to be behind. So yes, positive view there as well.
Positive view there as well. SW Solar, any thoughts, Hemang? It's one of those names which is cracked, and how? I think high was, I'm not sure. Let me just quickly take a look at this. So yeah, 828 was the high. Stock's at $400 now. After yesterday's 6.5% fall. Wow, it's up 10% this morning in the pre-open session. I'm not sure if there's any news flow, but that's a big pop coming through. Hemang, any thoughts?
So I would stay away from some of these solar and related theme, because I think there has been an overhype, and globally, if you see, things are not looking that encouraging. And here, despite the fall that we are talking about, the fact of the matter is that when you compare the valuations vis-a-vis their underlying performance, they are still looking quite stretched. So I would not, try to get into any of these names at this point. Let them settle down. Let's have more clarity about the growth, and then probably it would be good to kind of, enter into these names.
Okay, all right. You may want to listen into this currency view as well. Jayesh Mehta is with us now to talk to us about what the currency market will do. The rupee is open. Dollar rupee will, I think we'll have, we'll talk about this with Jayesh Mehta, who's with us, Vice Chairman and CEO at DSP Finance. Jayesh bhai, good to have you with us here as always. Thank you for your time. So where are we headed near term? You think the worst is, we've seen the worst for now, or this is going to be a gradual painful sort of move lower?
So I think it's more to do with U.S. equity, and like yesterday you guys were talking about U.S. exceptionalism. So that would continue at least till the election, and maybe maybe then it's a hope rate that maybe it continues for another 1 month, 2 months, or whatever it is. But it has to change. The narrative on U.S. equity will change, and the narrative might change for higher rates and lower equity in U.S. And that will still fuel a little bit of the dollar strengthening. But that would be good. That's when you will start getting the EM flows, and that's when the things would reverse. But till that time, yeah, another 1-2 months, we don't know. Hopefully just 1-2 months, and we should be okay. But it's nothing dramatically, but it's only U.S. then. of course, we should let it go where it was to settle. And then its only time is when it is changing back. We should not intervene much and let it appreciate when it is changing back. But we don't know what is the timing when it is changing back.
Okay. The only problem, Mr. Mehta, is that, in the past when there's been a problem in the US, investors look out for EMs. And now you don't know what this new administration is going to do to EMs also with all this tariff talk. Which is really my next question. I mean, the depreciation is not just the rupee's problem alone, right? We've seen that play out across a lot of currencies, including the Chinese yuan. What's the chatter in the market right now, Mr. Mehta, with respect to the RBI's approach towards this? Because this is a new beast that we're looking at, right, in terms of what happens on the tariff front. So could the RBI adopt a slightly more different approach and let it drift to where it wants to drift, given that we could be looking at some sort of tariff war, trade war, etc., till things settle?
So that will come to know only post 20th, or maybe don't even immediately. 20th is just the swearing, right? So that's why I keep on saying 1 month, and hopefully, political rhetoric and actual tariff war maybe not that bad, right? Because at the end of the day, every politician in the world knows that inflation is the biggest loser, right? So if you put too much of tariff war, the country suffers, right? And therefore, inflation would suffer, and therefore, you still will have higher rates with so much of fiscal deficit. So that doesn't make sense, hopefully. But we'll have to wait because nobody knows what he's going to do. Let's be very clear. Everybody's just guessing what he's going to do, right? And from that perspective, even nobody knows what he'll be allowed to do, because at the end of the day, he can right now say many things because he's still not the president. But once he becomes president, there will be a lot of things he'll be guided by. And I think he has a pretty good team he's building up on the treasury side and on the fiscal side and all that. So hopefully that should not be that dramatic. But that's a hope trade, as I said. But till the time U.S., one is right now U.S. equity versus EM. So that is continuing. Once that euphoria particularly gets over, it will be U.S. dollar rates. That will continue. It's only after that when people start looking at EM market, which will happen. We don't know the time, but that's the thing.
All right. Good morning, Jayesh. Always good to see you in. Thanks a lot for joining in. Well, could you give us some levels on the rupee? If you have in mind, if you could give us some rupee, some levels, point number one. Point number two is, we got into the year expecting the Fed to cut a couple of times at least in this year. Now it seems, the global backdrop has changed. In this backdrop, what do you expect the RBI to do? How many rate cuts are you factoring in, and from when?
So I think from a level perspective, it's very difficult to say. As I said, we can't even predict what the timing, right? It's like whether things change in 1 month, things take 2 months to change, right? So it becomes very difficult. But ballpark gut feel maybe at around 88, 89. So to start feeling the value into currency, other EMs, including India, right? So at some point of time, people will start feeling value in EMs. So that's where the things can change. In terms of more than India, I think the U.S. rate cut expectation has gone off. And that's where the longer for higher rate kind of situation. And so even if their equity market falters, which people feel it is, overshooted their earnings and stuff, then it's the people will say, okay, U.S. bonds, right? Because it's very attractive at 480 and stuff like that is very attractive U.S. bond market, right? Mm-hmm. So that kind of things will keep on coming. I think for India, I think we will have to wait for the new governor's stance. Traditionally people may say it is stupid to cut rate when your currency is under pressure, but currency is under pressure for a different reason, right? Currency is under pressure, not that people are doing an interest rate arbitrage between India and US. So if you cut rate to fuel growth, it's perfectly fine.
Well, a lot of complicated moving parts over here. Jayesh, we'll see how this plays out over the next couple of weeks. Thank you very much for joining in. For what it's worth, the rupee's pulled back at least a little bit from yesterday's lows. I mean, there's a mild appreciation, about, I think, 15 paise or so from yesterday's levels. There we go, 86.49 on the screen. Make that now just about 8 paise. Okay, back to the equity screen, which is suggesting that we will get a bounce in equities as well. About 80 points higher is what the Nifty is saying. Watch out for HCL Tech. The stock's down 2.5%, reacting to the numbers. The difference between TCS and HCL Tech is the fact that TCS went into earnings very weak, and therefore you got some positive commentary. So there was an uptrade. HCL went into earnings super strong. The stock was almost at a 52-week high, and then you're not getting a major upward revision in the guidance, and the market doesn't like that. Explains the reaction. Quickly getting to our technical experts. Sudarshan, 910, what's the call?
Well, consider buying Tata Consumers. Buy Tata Consumers with a stop under 940.
Okay, Tata Consumers. Mitesh, what about you?
I'll go with the buy on Kalyan Jewellers for targets of 595.
Targets of
95.
595. Okay, so that's it's in a very, very sharp correction, Kalyan. Mitesh, just a few more names coming your way. If you can just look at Novama, fell about 8-9% yesterday. K Fintech fell sharply. All these capital market plays. I mean, if the underlying market starts to look a little shaky, they may for a while be able to protect earnings, etc. But will it lead to some P contraction? Of course, we talk about market staying a little sideways. KFin, there's Novama, I think DAM Capital, which is recently listed, that also saw a bit of a knock yesterday. Of course, we've been talking about names like Angel and other brokers. Any thoughts here, Mitesh?
So I think, again, the fall has been vertical, which means that the structure is still negative, and on the weekly charts also now I'm finding weakness. The idea is that if you get a bounce back, and which you most likely will, I think try and exit, I think, on some bounce back. They might need some strong base building before they recover. For Novama, for example, I think, if it closes the week below 62, 70, 80 zones, then I think good chance that we will see the stock head towards levels of 55, 5400. Look at the rally. I think this will be a mild retracement to the entire rally. So for the timing, I think my advice in the short term, people who are trading with about 2-4 weeks kind of bias is to exit on every bounce start.
Very quickly, two more names, Amber and Policy Bazaar. Policy Bazaar has now fallen under 1700. Amber was down 10% yesterday.
Amber, Prashant, I don't have a view right now. Policy Bazaar has got strong support around 1640, 1620 zone. So I think this decline might get arrested.
All right, fair enough. 2 minutes to go for market open. JSW Energy is what we want to focus on. Sudarshan is here with details. Sudarshan, morning.
Morning, Prashant. So JSW Energy is in focus for today because company has acquired KSK Mahanadi Power under corporate insolvency resolution process, and total bid amount by the company was around 15,985 crore. But apart from JSW Energy, two companies that will be in focus are PFC and REC, because both these companies had given loan to JSW Energy, and by PFC had the biggest exposure of around 4,500 crore, and followed by REC, which has the exposure of 3,500 crore. So we are expecting that both these companies might reach amount once the deal is completed by JSW Energy acquiring KSK Mahanadi Power.
Okay, all right. Thanks a lot for that. So Darshan, just to give you a number, earlier the street was factoring around 27,000 crores. Now, if you put together the bid of 16,000 crores, add to it cash and receivables, another 16,000 crores, it's in excess of around 30,000 crores. That's why it could have a positive rub-off on those lenders, which includes PFC and REC. Higher than expected.
All right, we'll keep an eye out on this one. We've got the first tick starting to come up in just a bit from now. What do we have? 80 points higher in line with what the GIFT Nifty ended with. So there's a bit of a bounce, some green at least. Nifty Bank is up about 0.75%. That's clearly the weaker of the two indices. The mid-cap index is up 1%, and you've got the small-cap indexes, which is up about 1% as well. So there is a bit of a bounce which is starting to appear up on your screens. On your screen, right? I mean, you've got about 46 names in the green and about 4-5 names which are in the red at this stage. So 23, just under 23,200 with that 100 points to boot at this point in time. PB Fintech, we were just discussing this with Mitesh. So DG, Director General, GST Intelligence, I mean, I think there's some news flow there which was just flashing out there. But yesterday there was that sell side note downgrading their rating, but the news has come in this morning. Stock's down about 3/4, but it's already seen a very sharp correction. Surbhi.
HCL Tech, 5%. That's what happens when market expectations are running really high and the market doesn't get what it wants. I'm just reiterating, numbers were okay. There's a 90 basis points quarter-on-quarter margin expansion. The top line in constant currency terms is up about 3.8, 3.9%. Commentary is all right, but they haven't walked the talk in terms of revising the guidance higher in a more substantial manner. The market doesn't like it. 5% down on HCL Tech. It's taking some of the others down with it. Tech Mahindra, Wipro, Infosys, and even TCS has a tinge of red. So Tech is actually not supportive. It's pulling on the downside today. Almost 6% gone on HCL Tech. Anyway, let's look at what's moving higher. Then some of the PSUs are managing to pull back. BEL, 2.5% up on that stock. NTPC, SBI, these are some of the names. Some more metal stocks actually doing well this morning. Hindalco, Tata Steel, JSW Steel, all are looking quite decent. There's some buying on Maruti, Bajaj Finance, Titan. These are names that are holding up. BPCL is still going strong, after yesterday's complete slam dunk. You've got a 1.5% sort of a pullback on BPCL. Let's pull up HPCL and IOC as well to see what the other oil refiners are doing. All of them were down between 4 to 6% yesterday. Mild pullback underway. Other big stocks like Reliance are supportive for what it's worth right now. HDFC Bank is supportive, about 0.6% higher. Overall, the Bank Nifty is not bad at all. The Bank Nifty is outperforming the Nifty with a gain of 0.8%. So the only problem for the market right now is tech.
Well, and just take a look at the big mover this morning. BSE seems to be the stock of the morning. There's an upgrade that's coming in from Jefferies. So that's why that stock, in fact, is flying away. The important point out there, option volumes are down by 70%, but premiums are down by less than 10% in January. And Jefferies had anticipated a fall in premiums of around 25%. Because of that, the street likes it, and that's why after downgrading it initially, well, it's been upgraded again. That's why that stock is up close to around 3.5%. The ones that are feeling the heat, though, are brokers. You have Angel One, that's reacting to its numbers. Plus, in fact, they'll have to take some price hikes to offset this loss in volumes. That one's down close to around 4%. Anand Rathi is another one that's lower in trade. So that one as well is lower in today's trading session. Transrail, that's the newly listed company. Well, that one is bouncing back in today's trading session. It pulled back with the market yesterday. And as we said earlier, JSW has gone ahead and backed that deal from KSK in the resolution process. That means that recoveries are higher than what was expected, which in turn will play out for stocks like PFC and REC, and both of them are up by 2 to around 3% in today's trading session. They have pulled back big time, so any kind of glimmer of good news could help them pull back, and that explains that. Give you the levels you're looking at. On the Nifty, 23,350. On the Nifty Bank, 48,600, which incidentally is yesterday's level that we saw. So keep an eye on that.
On the capital market stocks, just wanted to point out, while Angel is reacting to its update and is weaker, Anand Rathi is weaker, look at Motilal Oswal. So it's not all things for the same brush. Motilal is, shooting higher, 5% higher, so it's slightly different. And while PSUs continue to pull back, Mazgaon is a big one that's seeing buying this morning. Almost 5% up on Mazgaon Dock.
So just a few other names here. So 100 points, by the way, so holding steady so far. And BSE, by the way, is with that 4% pop. Volumes are, very, very large. Volumes are by far the top traded volume gainer in the market right now. About 2 lakh shares, as you can see right there. Mazgaon is at number 2 in terms of volumes. Transrail is up 6%. It fell sharply yesterday. Adani Green and RVNL and MGL. MGL is up 3%. JSW Energy, we highlighted 4% higher. Inox Wind is up about 4%. So everything got sold indiscriminately yesterday. There will be bounces. So don't go looking for a specific news flow or reasons here or there. So there will be, a buying which will emerge if the market starts to look a little steady. On the downside, apart from HCL and Angel, Amber was down 10 yesterday. It's down another 1% this morning. Shakti Pumps, the big winner, was down yesterday. It's down another 1.5%. EPAC Durables is down 4%, so 518 on EPAC. And look at Delta Corp. Delta Corp is starting the day down about 3.5% as well. So that's the overall picture for now. 100 points is what you have on the Nifty, 23,200 or so. Well, let's welcome in our guests to who are going to take us through what the view for 2025 is. We are at a bit of a crossroads, aren't we? Samiran Chakrabarti is with us, Chief Economist India at Citi, and Surendra Goyal is Head of India Research at Citi India. Gentlemen, great to have both of you here. Thank you very much for joining us. So, gentlemen, we got Mr. Trump was ready to take over in less than a week. We got the budget which is lined up on the 1st of February, and you got the market which is weakened substantially going into these events. Surendra, if I can start with you, what's the top-down kind of view that you hold from an equity sort of research point of view? Has the market adequately factored in some of the fears? Has some of the overvaluation been corrected already?
Yeah. Thanks for having us on the show. In terms of, if you look at various parameters, firstly, from a valuation perspective, I think the valuations have moderated quite a bit. Now we are at close to in fact, slightly below 5-year averages, which like we have not been in the last, I would say, 18 months or so. So valuations to that extent for the broader market have moderated. But again, I would point out that this is more so for the large caps. Mid and small caps were kind of running ahead, and that's why we have seen a possibly bigger pullback. So large cap valuations are now kind of back to 5-year averages. From a flow perspective, on at least when we look at the EM funds and we track a bunch of funds, there when we look at it, the underweight for India as of end of November was already 180 basis points, which is like a 20-year low in terms of positioning. So I think EM investors are already underweight India by 180 basis points. The valuations have moderated. So from that perspective, the setup is a lot better. Having said that, obviously this year's earnings growth is also relatively muted. And I think some recovery is required to act as a catalyst to kind of take the market higher. So that's how we are really set up for this year. We will need some support, and Samiran can talk more about it. So as we get that, if growth improves, that's what the expectation is, that in FY26 earnings growth will be well ahead of what we saw in FY25. That, I think, is what will really help the market do better from here. From a market upside perspective, we are seeing around, say, 12-13% upside from current levels. That's what our December target for this year is.
Sorry, that point, Surendra, you said the underweight is 180 for EM investors. It's still 180 basis points.
This is as of end of November. The underweight has been increasing, and as of end of November, it was 180 basis points. This is based on a sample of EM funds, which our regional team tracks on a monthly basis.
Okay. If you look at the MSCI in Asia, ex-Japan, India weight is about just under 20% right now. It used to be 19.7 or something. And foreign weighting here is, I think, September on, I think FIs have sold another $20 billion, right, in India. So that number would be much bigger now.
No, I'm talking of the November number. And as I said, this is based on a sample of funds that we track on a monthly basis. So that's it. That underweight has been increasing, but as of November, it was 180 basis points.
Okay, just reiterating, Surendra, so 12 to 13% upside in the market, and this is largely, you're saying the large caps, right? That's where the bulk of this recovery will happen.
Yeah. So what we are saying is, from a valuation and growth perspective, large caps look a lot better compared to mid and small caps. In fact, the excitement we saw in mid and small caps last few years has taken valuations to really high levels. And a lot of the large caps are looking quite okay, even in the historical context on valuations. So as growth outlook improves a bit, I think that's where we see more upside. But yeah, at a market level, when I say it's a nifty target of 12-13% upside. 12 to 13% upside on the nifty. The investors and our viewers will love the sound of that. Everyone can do with some good news, right? The market's been slammed so hard last couple of weeks. Let me come to Samiran as well. Samiran, while, there's no point trying to second guess beyond a point what happens to flows and what happens to tariffs, I think the question I have for you is the local question, this whole growth conundrum, the slowdown that we've been in the sort of midst of. Where do you see things settling? And are you expecting any significant action, either from the monetary side or from the fiscal side, now that we're looking at the budget, to get us out of this funk?
So thanks for having me on the show. Our sense is that out of the 4 balance sheets in the economy, the corporate balance sheet, the financial system balance sheet, the government balance sheet, and the household balance sheet, 3 of them are just fine. It's only the household balance sheet which is under some stress. And that too, there is a somewhat of a different track going on between the urban consumer and the rural consumer. In particular, we think that the reason for the urban consumer slowdown has been twofold. One is that we are finally seeing some impact from the monetary tightening, the credit tightening on urban consumer. And secondly, the fact that the fiscal expenditure, particularly on capex this year, has been slower than usual, has probably led to some cash flow squeeze on urban consumer. So in some sense, the recovery paths will have to come from these two sides. Monetary policy will have to gradually ease. We think it's going to be a three-stage process. The first stage is going to be more liquidity easing. The second stage will involve modest 50 to 75 basis point of rate cuts. And the third stage probably could be some relaxation on the tightening of macroprudential measures that we have seen. On the fiscal side, while the government has committed on the 4.5% fiscal deficit number for FY26, and we think that commitment will be kept, if for the next 3-4 months we see the capital expenditure pick up to meet the budgeted amount, then that itself could act like a mini stimulus. So to that extent, the bulk of the policy side intervention will have to come from monetary over the medium term, but in the short term, the fiscal can also help. That would probably make the urban consumer recovery. And we are quite confident that the rural drivers are still strong. And that's why probably we get up to about 6.5%, 6.6% GDP growth for next year is what our forecast is right now.
All right. Hi, good morning, gentlemen. Good to see you in. Samira, and let me push you a little bit on that point then. When do we see the first rate cut? I think you're talking about 50 to 75 basis points for the entire year. But when do we see the first one? And also, what are you making of this rupee fall? You know, it went one way to around that 86.5 odd. It's pulling back a little bit today. So what are the levels you're looking at on the rupee?
So we have still our baseline as the February to be the starting point for the rate cut. We think that the inflation numbers are moderating quite nicely. Yesterday's print has been slightly below expectations. January print is probably going to be below 5, maybe something around 4.7. And in second half of the year, we should see inflation trending closer towards the 4% medium-term target that RBI has. So that opens up space for some easing. Unfortunately, global factors have not been that conducive. We've seen Fed rate cut expectations being deferred. The dollar is strengthening globally. And on top of it, the new challenge has been the rise in oil prices. So we'll have to observe these three factors from here to the policy date to farm up the view on whether we see a rate cut in February or it gets delayed by one more policy. And also we'll have to see to what extent RBI is taking the liquidity easing measures, which are very much required right now, because that will act as a signal for rate easing in February. In terms of the rupee, our near-term target was that 86.5, which has already been reached. Our more medium-term target is to move towards 88. But this is a bit of a moving target because it's partly a function of where the dollar is going to be in general and how the retaliation to all Trump policies are from other countries. Say, for example, our China economists think that there is a substantial 6 to 7% CNY depreciation possibility if as a retaliation to the Trump policies. And in that case, we could see more weakness in rupee also to some extent negate the effect of the CNY weakness. So at this moment, it's difficult for anyone to put a hard number on where we are going to be. But it's a good thing that finally the bit of a misalignment on a valuation sense that was there on the currency, that misalignment is getting corrected.
Samiran, just to check, you said 88 is your medium-term target and it could head lower depending on what China does. So when you say medium-term, is that end of the current calendar year? I mean, just to get a time sense?
It's about a 9 to 12 months ahead view.
Okay. All right.
Samir, on interest rates, and Surendra, this is for you as well, it's kind of become... so, for example, I think the Citi Global view was that we'll see numerous rate cuts, I think 6 or 8 this year in 2025. And I was reading post the NFP, it's suddenly looking very different now, right? I think another global bank, Bank of America, is now saying maybe the next move is going to be a hike and no cuts in 25. Has it become tough to kind of forecast? We can all, the one view is that, what we're seeing in terms of rhetoric is kind of peak Trump. And once he gets into office, he's going to be pragmatic and businesslike, and he'd not want to do things which will eventually cause pain for the US as well. But who knows? So just your thoughts there, Samiran.
So I guess one part of the discussion that you were highlighting is with respect to the Trump policies. But even if you take that aside, the US economy is showing a pretty strong growth outlook, different from what the market expectations have been. So our US economists now think that the next rate cut is starting in May only, and they think that the labor market weakness by that time will be more visible, and then we would see about 125 basis point of Fed rate cut this year. So they've kind of pushed back the rate cut expectations a bit because of the inherent strength in the economy. How Trump policies affect this, the most obvious channel is whether these tariffs increase the inflation in US. There, our US economists have estimated that if the tariffs are reasonable around 10-15% increase and not really 50-60%, then with that 10-15% increase, the inflationary impact will be quite manageable. So inflation will not play a spoil sport in the Fed rate cut view. But it all boils down to what extent the labor market softens from here. The inherent strength of the US economy, also known as US exceptionalism, I think that's the big driver of Fed going forward.
But it kind of is so wide now, right? I mean, there are those who are expecting, Citi, for example, is expecting 125 basis points of cuts. There are others who are saying the first move will be a hike. So it's really out there and directionally as well. I mean, the views are absolutely opposite. And that's what the market strength is, the surprise that you're talking about. Surendra, so how, for markets to do well, I think one way to put it is you don't need rate cuts necessarily, but you certainly don't need hikes. Is that the way to look at it, Surendra?
See, I think rather than focusing on just one variable, I think there have been a bunch of things which have resulted in slowdown in earnings, right? You look at it sector by sector, there are various reasons. You have seen it in banking, you have seen it in consumption. And I think some of it are driven by more temporary issues. And I think as those things resolve, right? And Samiran mentioned kind of some of the policy measures which will really help there. I think as those issues resolve, we should come back to more the kind of growth rate that we typically get on earnings in India. If you take a 10-year view, Nifty earnings 11.5% growth CAGR. And that's like among the best in the world. And that is what really kind of drives the market. In this year, there has been a moderation. In the current year, we have seen a moderation. And I think if some of those factors kind of come back next year, we get back to a better growth rate. And that's what is really required for that upside to come through. In the meanwhile, I think the market will focus on sectors where there is growth visibility. And at the same time, valuations are relatively reasonable. So that's how we are kind of thinking about this year.
So, Surendra, I was coming exactly to that because, you're giving us optimism. You're saying that at a headline index level itself, the market could be up 12 to 13%. The question is what to play. So we've discussed, Samiran laid out the RBI roadmap, the expectations on easing. I think a lot of people are wondering whether to continue with capex themes, industrials and capex, given the expectations that there's going to be a pickup in government spending, or whether to start looking at staples. I've been, wondering whether the government will have a more populist tilt to soften the blow at the lower end of the pyramid. So top down, just take us through the portfolio construct.
Yeah. So see, at this point of time, given where we are kind of focused on sectors where we see decent growth visibility, and at the same time, valuations are relatively reasonable. So if you look at the key overweights that we have, select large banks, and again, large banks where growth has been relatively better. At the same time, asset quality, given the diversification, is relatively better. And obviously, sentiment is weak on the entire banking space. It's been tough for a while. So valuations in that context are attractive in the context of history. So that's kind of one part where we are overweight. Secondly, telecom is more around kind of good trends continuing. So we have seen healthy trends in the sector. So a couple of our top picks are in that space. Healthcare, we like both hospitals and pharma selectively. Again, decent visibility, kind of decent compounding. So for now, those are the categories we are overweight on. Staples, we are neutral. I think stocks have corrected a lot and risk reward has become favorable, and they can be defensive in this kind of a market. On rest of consumption, as well as IT services and metals, those are the sectors we are still underweight on.
Okay, all right, gentlemen, we appreciate you joining in. Thanks a lot for giving us the update in terms of your outlook for the markets for this year in the near term, both in terms of monetary policy as well as on the markets as well. Well, let's hop across to Nimesh. He's gone through a brokerage report where Bernstein, they're giving 11 bottom-up ideas. Nimesh, fill us in with the list.
That's right, Nigel. They've done some changes to the model portfolio and they've identified 11 bottom-up ideas. In terms of additions, they've added IndusInd Bank, Coforge, Bharti Airtel, Adani Ports and Jubilant FoodWorks. Some of those names are purely because of the sharp correction that we've seen of late. In terms of deletions, they have Reliance, HDFC Bank been deleted, REC and Zomato. These are the 4 names which have been removed from their model portfolio. Now coming to individual sectors and stocks, they've actually increased their allocation on IT services and consumer names. Within consumer basket, while they own DMart, they've added Jubilant FoodWorks and they've removed Zomato. So that's the change in the consumer basket. Within the industrials, they've added Adani Ports, largely because of the sharp correction that the stock has seen in the last few months. Same is the case with Bharti as well. After the recent correction, they like telecom, and within that, they've added Bharti again into their model portfolio. Within the financials, that's interesting. While they've retained ICICI Bank, they've added IndusInd Bank into the model portfolio purely on back of the sharp correction that the stock has seen in the last few weeks. They also like REC within utilities, but they've removed REC and they continue to own NTPC in that utility basket. In the insurance space, they continue to like SBI Life, and within the other utilities, they own NTPC as well as L&T as well. So these are the few changes that they've made to the model portfolio. The key to me was adding some beaten down stocks like IndusInd Bank and Bharti Airtel and the likes of Adani Ports, which have seen very sharp corrections in the last few weeks.
Right, Nimesh, thank you very much for that interesting list there. And, we'll sort of invite Venu of Bernstein to talk about some of these changes as well over the next couple of days. But thanks for that. Well, HCL Tech is, of course, the one in focus, largely inline set of numbers. But, of course, expectations were higher. And the stock is reacting accordingly. My colleague Rima caught up with the management of HCL Tech, began by asking them about the company's decision not to raise their organic growth guidance. Listen in to a slice of that conversation.
Our earlier guidance was 3.5% to 5%. Now we have raised the upper end of the guidance from 3.5% to 4.5%. So the new guidance is 4.5% to 5%. So 0.5% increase in the lower end is due to the organic improvement, and 0.5% is through the contribution from the HPCTG asset that we acquired. So overall, it's 4.5% to 5%.
But CVK, the asking rate for Q4 is minus 1.3 to plus 0.6%. Which means you aren't expecting any pickup, even if you account for the reduction in seasonality in your products business.
Yeah, so the software business, as you know, will have a big seasonality we had a big peak in December. Now that will come off in JFM quarter. And as I discussed yesterday as well, I think our momentum across all the verticals is continuing to pick up. And there will be some impact because of a large program coming to an end in the retail CPG segment, where we had a 14% sequential growth last quarter. Now, to backfill that project with new projects, it will take some time because some of the deal wins have happened towards the end of the in December quarter. So that pickup will happen towards the second half of the March quarter, and that will continue into the Q1 of next year.
And what would be the loss in Q4 because of this large retail CPG program coming to an end?
I think that will be roughly $30 million.
About $30 million. In the current quarter, you also spoke about some delay in signing certain large deals and renewals. Can you tell us a little bit more? Was it one specific deal or is it a little more broad-based? And what's happening on the client corporate conversations now?
No, I think overall the conversations, the lot of good interest in using generative AI for both innovation and efficiency. And that is directly leading into a lot of conversations on data, application modernization, some more cloud migration and transformation kind of opportunities. So I think the conversations are getting a little more productive in terms of good programs that could materialize for us. We saw that in end of September as well. We did indicate there is some green shoots of growth in financial services and tech as well. We saw some improvements, and that is reflected already in our broad-based growth in Q2 and Q3. Now Q4 as well, across most verticals we will grow, except the some of the specific things that I called out will have an impact in Q4.
So Q4, all verticals should grow, ex of retail and CPG?
It would be more broad-based. There could be some could be flattish, but I think the way you should interpret this is, I mean, every vertical has some dynamics that plays into every quarter, but is the new additions adequate enough to kind of offset some of those reductions is what we should see. We are quite positive of an all-round growth in Q4.
Positive of an all-round growth in Q4. Shiv, in Q4, typically you have the wage hikes for senior management. So Q4 margin should be lower than Q3, and what would be the impact of hikes?
So as we announced last quarter also, the impact is going to be somewhere between 50 to 60 basis point. Yes, the margins in next quarter are going to be slightly lower than Q3 because Q3 has an impact of seasonality of the software. That's the only variation I can see. Otherwise, rest I think it should be fine.
But if client conversations are positive, your deal wins have been stuck in this $2 billion band.
Yes, I think there is a little bit of mechanics there. If you see, the ACV has grown very nicely, and the tenure of deals are becoming a little shorter, from 3 years to 2 years. Now it's about 1.6 kind of tenure is what we are seeing. I think there is a good momentum in a number of small deals, and that has a potential to convert to revenue quicker. Some of the large deals conversions continue to be a little slow, but we expect that to pick up with some of the uncertainties behind us. We think the large deal momentum should come back in this quarter and maybe Q1 of the next financial year.
And how would you qualify CVK discretionary demand as you see it right now versus what it was 3 months ago?
It's definitely better.
Okay, and it would be better across which verticals?
I think barring life sciences and healthcare, all verticals, it looks good. And maybe a little bit in energy and utility, some softness, but financial services is good. Tech vertical is looking good. Telecom also, there is a lot of efficiency-led improvements that clients are looking for. That is also creating good demand. Then manufacturing is also looking good, retail CPG as well, barring some one-off things that might happen quarter to quarter. But the general theme is positive across most segments. And you were talking about large deals, and we announced one deal. I mean, of course, it is part of our IR pack that we released yesterday. This is a strategic partnership between HCL Tech and Microsoft on transforming the contact center space using generative AI and cloud solutions. So I think there is a lot of interest in using generative AI to transform different aspects of business, and contact center transformation is a big theme, and we are very well positioned. And this partnership with Microsoft will give us significant capabilities in conversational AI, conversation design, and things like that, which are going to be very instrumental in driving the true leverage of generative AI in the contact center business.
And this would be a large deal? Would this be the first large generative AI-led deal?
Yes, I would think so.
Just getting back to the vertical specific outlook, what is ailing life sciences in healthcare? Even the TCS management sounded downbeat on that particular vertical. So what is the exact, regulatory headwind that you fear? Or what's holding back the clients?
I think some of the firms, especially in the medical devices, they're also going through certain inflationary challenges and cost increases in their own supply chains. I think that's kind of putting a little bit pressure, and I think that should also ease. That's the way we see it. Maybe it's a quarter or two away, but definitely we have a good pipeline even in life sciences and healthcare.
Shiv, what's the outlook on hiring, for calendar year 2025 or the current quarter, and the view on attrition? Is attrition going up or is it going down? What's the visibility?
I think on hiring front, I think this quarter we hired around 2,000 freshers and added at a company level over 2,200 or so. And for the remaining next quarter, the plan is to hire at least add another 1,000 freshers. And given the uptick in slightly, broad-based situation, so it looks like I think next year we think that we would increase our fresher intake substantially, but it's going to be more the specialized skill hiring than the numbers. That's the plan we have for next year.
Okay, that's HCL Tech, and now we know that it seems like the ramp down of one contract, a reasonably large size contract in the retail vertical, is making them a little cautious, and that's why they have not increased their guidance, the upper end of the guidance, and that is the disappointment that's playing out on the stock price. Otherwise, the earnings were fine, commentary is largely positive, but right now 9% down on the stock. Let's take a break, come back on the other side, and it'll be time for our special segment, Quarter Se Quarter Tak. Today, we put the spotlight on the financial space.
Welcome back. Well, the IT index actually is letting the markets down today because HCL Tech was a little bit soft. But I'll tell you what, there's a positive trend playing out on Nifty Bank. And I say this because that's been the big drag. It's bouncing back from bombed out levels. And if you just pull up a chart on a day-to-day basis for the last many sessions, it's been making lower lows and lower highs. Take a look at what's happened today. That's January 14th. Now it's made a higher high for the day. That's after a long while because otherwise it was trending down. And even on the lows, it's made a higher low as well. So hopefully, at least in the near term, there's a sense that maybe in fact the Nifty Bank could be seeing some kind of a bounce, and that's precisely the reason that it's outperforming today. Talking about banks, well, it's time for our special segment, Quarter Se Quarter Tak. We're bringing you earnings expectations from each sector. Abhishek joins us to help us out with what are the expectations from the banking sector. Abhishek, take it away.
To begin with, in Q3 FY25, you saw the deposit growth on a year-on-year basis being at 9.9%, and sequentially, that is quarter-on-quarter, the growth was at 2.6%. So the deposit growth on a year-on-year basis is the lowest that you are seeing since March of 2023. Advances growth was healthy at 11.2% YOY and 3.6% sequentially. Loan growth was higher than deposit growth as RBI has brought down the cash reserve ratio requirement in the previous MPC meeting. Hence, you saw loan growth outpacing deposit growth by the end of Q3 FY25. So the credit deposit ratio as a resultant has been at the highest ever that you are seeing from the industry of about 80.4%, reflecting a more aggressive lending stance by the lenders. This augurs well for some lenders in case to maintain their net interest margin at healthy levels. So if they are able to curtail or bring down their slippages. So the net interest margin is expected to remain largely stable for for most of the large banks in case they are able to hold on to their slippages. Now, we may see marginal decline for some of the lenders. Net interest margin will also get impacted for lenders with higher slippages, especially in the unsecured portfolio in Q3 FY25. So the net interest income over here, the growth of NII is expected to be sluggish, especially for PSU banks. Why PSU banks? PSU banks have largely raised deposits at higher cost while their loan growth is lower than the industry levels. So the credit cost for certain sectors, especially those with unsecured lending like personal loans, credit cards and microfinance, they are expected to face higher credit cost in Q3 FY25. This could be as a result of higher defaults in that segment and hence incrementally increased provisions that needs to be made over there. Now, there is a need for more evidence to confirm whether these higher costs or higher credit costs are stabilizing. So earnings outlook, overall, the earnings are expected to remain weak, especially for PSU banks. Now, PSU banks over the last few quarters had been drawing their profits largely from the treasury gains, and this time around, it may not be there. So for some lenders, higher credit cost can also impact their earnings momentum. Overall, earnings momentum expected to see weak momentum for the banking sector in Q3 FY25. Talking about asset quality, while asset quality is generally expected to remain stable, the concern remain around the unsecured portfolio, which are expected to witness continued deterioration like they did in the previous quarters. So X of unsecured loans, largely the asset quality is expected to remain stable for the sector or improve for the banking sector. Back to you.
Okay, all right, got it. Abhishek, thanks very much. Some of the highlights that we need to watch out for in the third quarter earnings season. Well, let's quickly move ahead and say hi to Pranav Gundapalli, Senior Analyst, India Financials at Bernstein. He's with us now. Pranav, thanks for joining in. So let's start with your sort of big picture expectations, because I think everyone knows, and the issue here is that is the best behind. Now we'll start seeing credit costs rising. Eventually, there might be pressure on margins, and that's showing up in the way investors are looking at financial stocks as well. Let's start with the large banks first. What could be the best, and what could be some of the worry points that you'll watch out for?
Good morning. See, I think you rightly said it's the best is behind us. I think what we are now looking for is an earnings reset, right? So we know the current level of ROA is much higher than what I would call the sustainable level. So there will be a decline in NIM, especially with a rate cut potentially coming in, and credit costs will inch up at the broader sector level. So it's not a significant deterioration that we're talking about, but still the credit costs will inch up. So yes, the ROA will decline. We've already seen the growth drop from near 16% level that we saw last year to about 11%. So overall, a weaker set of numbers with growth dipping and potentially profitability dipping as well. But that's largely priced in. So if you say where would be the surprises, I would say most of the surprises will come from the asset quality trends. While there's only been a gradual increase in credit cost, the trends have been mixed amongst the various banks. Some of them have seen a sharper rise, while others like say ICICI and HDFC have seen pretty much a flat credit cost over the last few quarters. So any variation to that trend would drive a positive or negative surprise, depending on which way the surprise comes in.
Pranav, hi, good morning. Prashant here. And good to see you back on the channel. Now, for players like, I mean, if you can sort of talk about specifics, IndusInd, for example, would you have coverage on the name, IndusInd?
Yes. So on IndusInd, for example, would be one of the banks where the West is largely priced in for the asset quality. And hence, any improvement in trends or even a clear signal that we are at the peak credit cost would be the major positive surprise to watch for, right? Whereas for others like, say, ICICI or HDFC, I think the expectation is that the current trend of almost unimpacted credit costs continue, and hence even a slight deterioration would be a big negative surprise.
So, because this has got the microfinance bit as well, so you're saying now you're expecting a turn, or you're saying, well, the price, stock price is already factoring in, even if the third quarter turns out to be a poor one for IndusInd?
The stock price is factoring in the worst case scenario. I mean, I think even if you assume they have eventually losses of well over 15% of their microfinance portfolio. Even that has been priced in, with the stock trading almost at book or slightly below book in terms of forward multiples. So the worst is priced in. I think it's only a question of how long does the pain last. And in that sense, and given that MFI tends to be a shorter duration cycle, any signs that we are close to the bottom would be a positive. So nobody expects a big improvement soon, but a sign that we are at the bottom is probably good enough for this quarter.
From the banking space, is that the one that you would, because it's we were discussing earlier Bernstein's sort of 11 ideas, and IndusInd is part of it. Is there anything else there?
Yeah, I think we like it because at the current valuation, like I said, the worst is priced in, and we know that the pain in MFI will be short-lived.
I was asking anything else from the financial space apart from IndusInd.
We continue to like HDFC because against the trend of ROA decline across banks, we see that as one where the ROA could remain stable or even see an improvement. So that's the other place that we would be bullish on.
Okay, you'll be bullish on HDFC Bank from these levels. Is that correct?
Yes.
All right. What about PSUs? Namely SBI. That stock had a one-way run, and then it's gone through a long phase of consolidation. PSUs as a basket, only they have fallen a little bit out of favor. But from the PSU basket, how do you approach it? And SBI would be top of the list?
Within the PSUs, yes, SBI would be top of the list, but we would still wait for a while for the PSUs before jumping into PSUs, because we believe the loan growth for the PSUs is still much higher than what I would call the sustainable levels. We expect their loan growth to converge with their deposit growth, which remains significantly behind the private sector peers. So to illustrate that, if you look at FY24 numbers, the PSUs were growing their deposits at 8-9%, whereas you had the private sector banks growing deposits at 17%. But when you look at the loan growth numbers, they almost were very similar. So I think that loan growth gap has to diverge. And until that plays out and the slower growth is priced in, we would remain almost neutral on SBI. No reason to jump in at this point.
Pranav, just curious, you said that you also like HDFC Bank, right? But I think in the note that Prashant was alluding to, in terms of the additions and deletions, IndusInd Bank is an addition, but HDFC Bank, I think, is a deletion. Correct me if I'm wrong.
Oh, yeah, so that, I think you're referring to the overall portfolio, where I think the factors were slightly different around the size of the bank and therefore impact on index. So as for those who are looking as a standalone idea, we remain bullish on HDFC Bank. All
right. So that's one clarification out of the way. What else? We've discussed some of the larger lenders, but if we talk about asset quality issues, I mean, MFI is well documented. We know that. Any other specific names where a rise in credit costs or any sort of asset quality deterioration could be a fresh sort of worry for the market? Where else would you watch out for these trends to show up?
See, I think we think it'll just continue. We don't see a scenario where it worsens significantly from the levels we saw in the last couple of quarters. So for the likes of Bajaj Finance, for example, or SBI cards, we don't see an immediate improvement in credit costs, and hence we remain on the sidelines on both these names. But any signs of further deterioration would be a significant negative. Our assumption right now is this pain continues for a few more quarters, and therefore the growth resumption happens again after a few more quarters. So we could see the stock go sideways for a while before seeing any meaningful re-rating.
Okay, that's an important one as well, that at least it should not get any worse, maybe just stay sideways and, expect some of these lenders to pull back on growth till the asset quality issues improve. On margins, Pranav, just give us a broad big picture, because that's also a wide open debate right now, what the RBI does, how many rates, etc., given everything that's happening in the international markets. But on margins, largely, what is the kind of compression that you've started penciling in for private names, for PSUs, just across the board? What should we expect?
Right. See, I think there are two factors here. One is the rate cuts, and even if you ignore the rate cuts, there's probably going to be a slight dip in margins because you have a slowdown in unsecured growth, which used to be a big driver of margin improvement. So until the rate cuts kick in, we expect a marginal decline in NIMs, maybe about 5 basis points here or there. With the rate cuts, the private sector banks will see a sharper dip in margins. We're talking about 15 to 20 basis points dip in NIM if there is a 50 basis points of rate cut. Now, our base case assumption is for a 50 basis points of rate cut this year, which should drive between 15 to 20 basis points of NIM decline. That number would be a lot lower for the public sector banks, maybe closer to 10 to 15 basis points. But almost all the banks will see a decline in NIMs. And in terms of rank order, IndusInd once again will stand out as probably the least impacted, just given it has a very high share of fixed rate loans. But for most of the others, the impact will be quite similar. Not a lot to drive a big preference simply based on the rate cut impact.
Pranav, do you have coverage on the MFI space?
We look at IndusInd and therefore track the others.
So that covers it kind of, but yeah. Names like Credit Access, etc. from the pure MFIs, or you think, the best way to play it is through IndusInd?
I think with pure MFIs, there are probably one or two names where you could look to gain exposure. And there again, I think our view is, one, you have two paths to this whole re-rating. One is the asset quality trends where, you could probably see a bottom soon. But the second leg of re-rating will require growth to come back, which we think is at least a few quarters away. So yes, closing in towards the bottom of asset quality, but recovery in growth seems to be much further away. And hence, the extent of re-rating might not be as sharp as probably what is being expected.
All right, Pranav, we leave it there. Good conversation as always. Thank you very much for joining us and running us through the perspective on financials and as they start to report numbers for the third quarter. So it's going to be an important one. We'll take a quick commercial break here. We put the focus back on commodities. Manisha is going to be here with that. Manish, on the other side. Stay with us.
Welcome back. So the markets are managing to hold on to that green, though it's 65 points now. So again, the slight drift down from the top of the morning has already started. Let's see where it goes. We've got Mitesh joining in for some ideas. Mitesh, welcome back. Index, any trades, otherwise stocks?
So, I think that while we have seen some selling off from the higher levels, the Nifty, if it can, get past 23, 180, 200, there could be a bounce back of about another 120 odd points. So I'm waiting for that 23, 180 to be taken out. Once on this spot, the Nifty clears that, buy with a 40, 45 point, maybe 50 point kind of a stop and look for another 120 points on the upside, which is 23, 300 plus levels. So that's the way we're approaching it. And now, I think it does look like that this could be a bounce back, though I think we have seen some tapering off from the higher levels. A lot of stocks, a lot of index indicators are now turning up on the upside on the 15-minute, 30-minute charts, etc. So I think there's a good chance of a pullback happening. But again, as I said, I think I'm waiting for 23, 180, 185 to be cleared on the Nifty spot, and then I would take a long position.
Okay. Stocks, Mitesh?
On the stock side, I have a buy on TCS. I think, after good numbers and then gap up, we had some kind of a pullback today. So buy here with the stop below 42.45 and look for a target of around 4,400. And SBI card is the other one, which I would recommend buying with the stop below levels of 709 and look for targets of 750.
Okay, all right. Got that, Mitesh. Let's quickly move on and look at the commodity markets. Now we've got Manisha joining in with the latest. Manisha, so how's it looking after this, 8% surge in crude prices, right, so far in January?
Well, I'm looking at the sugar prices today, where we have seen the U.S. sugar prices decline to a 4-month lows. The London sugar prices are trading at around 2-year lows, and the Indian sugar prices in the last 1 year also have seen a decline. So much so that the ex-mill prices are almost at cost of production or below cost of production for many mills in India. Well, the dollar index at a 2-year highs and improved global supply outlook is what's weighing onto the markets. So if you look at the prices in the last year, we saw sugar decline by 8%. In 2025 until now, the sugar prices are down by 2% as well. But the markets are looking at India perhaps allowing sugar exports. That review, of course, will come in by the end of this quarter, but that could really increase supplies in the global markets. India, remember, has restricted sugar exports since October 2023. Before that, we saw 6.1 million tons of export, and then, of course, it was a record exports of 11.1 million tons in the year 2021-22. It also is about supply outlook getting favorable with other producing countries. Brazil, which is the largest producer of sugar, is also looking at a higher production. Thailand, which is the third largest producer, also is looking at nearly 18% of a run. And U.S. sugar production also is expected at a record 9.4 million tons. Is the reason you have seen the sugar prices continue to decline here. Well, for the Indian markets, we still are awaiting for minimum sugar price being revised. And of course, the ethanol pricing, which has not been revised since 2022-23, is something that these markets are awaiting, and that perhaps is impacting these margins as well. But apart from that, while our current sugar production is down by 15%, but this data is as on 31st of December, the street will wait for 15th Jan. That is when the newer data will come in, and of course the reactions would come in for that as well.
Right, thanks very much, Manisha, for that. Angel One, back to stocks, is down 5.5–6% now, almost at the day's low. Vamakshi is here to revisit this one. Vamakshi.
Well, absolutely. It's a weak set coming in from Angel One. When you look at the revenue, that saw a downtick of nearly 17% sequentially. The margins contracted by nearly 507 basis points from nearly 44.4% to 39.3%. The net profit too saw a dip of almost 34% sequentially, coming in at 281 crores, and this is below what the street was expecting. Now, the decline in revenue is largely being led by the net broking revenue. Now, this saw a dip of nearly 10%, and this is mainly on account of two factors. Firstly, the F&O regulations that came into effect, which had an impact on the F&O part of the brokerage, and the weak market sentiment had an impact on the cash segment part of the brokerage. Net interest income came in nearly 6% lower, but this was largely better than what the analysts were expecting. As far as the margins are concerned, higher OPEX led to the decline in the margins. The cost to income ratio stood at 60.71%, which is much higher as compared to 55.65% that we saw in the previous quarter. So given that, we saw a dip in the net profit, but apart from that, they've also come ahead with a few announcements. They've appointed Ambarish Kenge as the group CEO with effect from March 6, 2025, and they've also declared a first interim dividend for FY25 at 11 rupees per share. But overall, it's a weak set coming in from the company.
Okay, all right, Vamakshi, thank you very much for that. MGL is something we want to address once again with Sud. Sud, morning.
Morning, Prashant. So MGL is in focus. Today stock is higher around 4% because Morgan Stanley has initiated coverage on the stock with an overweight call, and target is rupees 1606 per share, implying an upside of more than 25% from current levels. Morgan Stanley believes Mumbai is an ever-expanding city with rising travel and energy needs, with natural gas being Mumbai's fuel of nature. It goes on saying that it is both MGL and Mumbai's Tesla-like moment for the gas adoption. And MGL has fifth of its gas sourcing linked to LNG. And because of this, while margin will be lower, volume growth is expected to be structurally higher, which is going to be the key for re-rating of the stock going forward. And that's the reason you are seeing an uptick in MGL today.
All right. Okay. Got that. So some green on MGL. Thanks to that note, Sudarshan. Appreciate you joining in and filling us on the latest. Right now, we have to take your leave. That's Prashant and me. But Lata is in the house, and I'm sure what else? But it's the currency that's captivated your imagination, Lata.
Yeah, I just want to make a brief point. The rupee has strengthened, as have all Asian currencies. But over the past week or so, especially yesterday and today, this week, very clearly the rupee is an underperformer. All of last year, the rupee fell, but we fell only 3% all of last year, whereas the won, Taiwanese dollar, IDR, Malaysian ringgit were all falling between 5 and 10%. I think one of them was even double digits. This year, it's the other way around. And I think the difference is the India growth story. Even today we have appreciated, but we have appreciated by 0.04%. Some of them have appreciated to 0.2, 0.5, 0.4. The others. So again, we are underperforming even in the appreciation. The difference is we were seen as a growth story last year, whereas now we are seen as, okay, let's wait and see whether the growth is coming. And until then, I think this underperformance will continue. Otherwise, we moved with the dollar. Yeah. In any case, I think the overall depreciation is not very serious. I went back 5 years. We are depreciating a year 3.3%. Yeah. Okay. So, to that extent.
One other change, Lata, from last year, new governor. I'm not sure how much of that is.
I don't think global currencies take that into account.
No, some chatter that they're a little more allowing off.
All governors can allow, under the same governor 2 years ago, that is under Shaktikanta Das, the currency depreciated 5%. We just forget it. It happened during a COVID year. We forget that. It was not as if we stood against every wind. But this year, that is 2024, the Reserve Bank was a little more stubborn, thinking that the India growth story is good, and they're fighting speculation.
$60-70 billion, actually, right?
Yes. So, but they also earned $100 billion, so they did both things.
All right, well, that's the discussion which is going to come up, and Lata will take you through that on It's the Economy, which will come up in just a bit from now. So we'll have Kamaksha Trivedi of Goldman Sachs to discuss all of this and more in a bit.